Today, we're walking through a practical end-to-end process for raising capital for a small or mid-sized business. That could mean growth capital, a partial sale, or even a full exit. The twist is we're looking at it through the lens of working with an investment banking advisor. Because the process is different when you have someone orchestrating the market outreach and positioning.
And let's be honest, most founders don't struggle because they have a bad business. They struggle because they run the process like a casual set of conversations instead of a structured transaction. So we're going to outline the deal runway from first discovery all the way to signatures and wires.
Quick framing question for listeners. When you say raise capital, do you mean you want money while keeping control, or do you ultimately want liquidity and an exit? Because those are different goals, and they influence everything: valuation expectations, investor type, deal structure, and even the story you tell.
Exactly. So let's start where a good advisor starts: deal and entity discovery. This is the phase everyone wants to skip, and it's usually the phase that determines whether things go smoothly later.
Discovery is both qualitative and quantitative. Qualitative is things like, what does the company actually do at its core? Why do customers choose you? What are the real value drivers? How dependent is the business on the founder? What are the operational bottlenecks?
And quantitative is the hard data: historical revenue, margins, cash flow patterns, customer concentration, churn if it's recurring, backlog if it's project-based, unit economics, and balance sheet health. Not just the numbers you like, but the numbers that an investor is going to interrogate.
A good investment banker also maps the entity side: legal structure, cap table reality, outstanding options, debt terms, liens, any weird shareholder arrangements, and anything that could slow down a transaction later.
Which leads into the next step: validation. Think of this as preliminary due diligence. Not the deep dive investor diligence yet. This is the internal version. What could break the deal, reduce the price, or delay the process?
Right. Validation is where you ask uncomfortable questions early. Are your financials clean? Do they reconcile? Are there unusual add-backs that won't survive scrutiny? Are key customer contracts assignable? Are there compliance gaps? Any unresolved litigation?
And there's a mindset shift here. Founders often treat diligence like an exam they hope to pass. But the better approach is to treat diligence like product testing. You want to find issues early so you can fix them, frame them, or price them intelligently.
After validation comes the analysis of the mandate. This is where you decide what you're actually trying to accomplish and how the market should see it. Not just, we need money, but what type of transaction, what size, what structure, and what's the rationale for buyer or investor?
And this is where classic frameworks help. SWOT, strengths, weaknesses, opportunities, threats, keeps it grounded. VRIO, valuable, rare, inimitable, organized, helps you locate what's truly defensible.
Because if your value proposition is easy to copy, investors will either push price down or demand more control. The analysis phase helps you figure out what leverage you actually have.
Let's add something practical. The mandate analysis also clarifies the why now. If you're raising growth capital, what will the money do, specifically? Launch a new product line? Expand distribution? Acquire a competitor? Invest in sales capacity?
And if it's a partial exit, what are you selling and what are you keeping? Are you rolling equity? Staying on with a new partner? Reducing concentration risk for the founder? Those details shape the buyer universe.
Next step is narrative and packaging. This is where many deals win or lose before the first call. Because investors don't fund spreadsheets, they fund a belief that the company has a credible plan and a compelling edge.
Packaging usually includes a few core pieces. One is a mandate at a glance, basically a crisp overview: who you are, what you're raising or selling, the headline financials, and what makes the opportunity attractive.
Then there's the teaser, which is a short, often anonymized document that gets an investor interested without giving away the identity too early. The teaser's job is not to explain everything. It's to earn a meeting.
And then there's the bigger document, typically a CIM, confidential information memorandum. It's the full story: market context, product and differentiation, customers, go-to-market, operations, management, financial performance, and forecast with assumptions.
One thing that's underrated is a readiness assessment. Before outreach, you want to be honest. Are we ready to run a process? Do we have a data room plan? Are monthly financials consistent? Can the team handle diligence while running the business?
Because a transaction is not only about getting a term sheet, it's about surviving the process long enough to close on good terms.
Now we get to investor potential fit discovery. This is where the advisor earns their keep. The key is not who has money, it's who has money for this type of deal, at this size, in this sector, with this structure.
Exactly. Fit discovery usually has two lanes. First is warm investor relations, people you or your advisor already knows, prior contacts, funds you met before, strategic partners, industry relationships. Warm intros can move faster.
Second is market mapping. Who is actively doing deals in your space right now? That means understanding their mandate, typical check size, whether they prefer majority or minority positions, whether they do roll-ups, whether they like founder-led businesses, and how much dry powder they have, capital they've already raised and need to deploy.
And also their historic structures. Some investors always push for certain protections. Some love preferred equity. Some want heavy governance. Some are flexible if the opportunity is strong, knowing that before you engage saves huge amounts of time.
Okay, then outreach to investors. This is not send a deck to 200 people. This is a controlled process. You're creating momentum, competitive tension, and clarity.
Typically, there's a staged approach. First, you confirm interest at a high level. Then, once an investor signs an NDA, you share more detail, often the CIM and access to a first-pass dataset. You schedule management calls. You track feedback carefully.
And the outreach needs a narrative arc. If everything is dumped all at once, the investor can cherry-pick weaknesses early. But if you guide them through the thesis, market, traction, moat, and then the financial proof, it lands differently.
Now comes exploration of interest and preliminary discussions. This is where people start using terms like indication of interest or LOI, which is a letter of intent.
Let's make that simple. At this stage, you're trying to answer, who is real and who is browsing? A serious party will engage on valuation range, structure, timeline, diligence scope, and what they need from management post-close.
And it's also where you learn what each investor truly cares about. One investor might be obsessed with customer concentration. Another might focus on gross margin stability. Another might have a strategic angle and care mostly about cross-sell potential.
This is where a banker can help translate investor feedback into either better positioning or smart concessions. Not every pushback is a deal killer. Sometimes it's just incomplete context.
Eventually, you try to drive toward an LOI or multiple. And here's a key point. The best LOI isn't always the highest headline price. It's the one with the most credible path to closing on acceptable terms.
Yes. You look at financing certainty, diligence demands, how aggressive the representatives and warranties might be, how they're thinking about working capital adjustments, earnouts, rollover equity, governance, and control.
Once you select a preferred party, you enter final due diligence. This is the deep phase. Financial quality of earnings, legal diligence, tax, operational, cybersecurity if relevant, HR, customer calls, vendor checks, the whole thing.
And psychologically, this is where founders get worn down. The requests come fast, and it can feel personal. But it's mostly risk management. The buyer is trying to confirm, is the story true, and are there hidden liabilities?
The best way to survive final diligence is to be organized and proactive. A clean data room, quick responses, consistent answers, and no surprises. And if there are surprises, you disclose them early with context and a plan.
Then documentation and close. This is where term sheets turn into real contracts. You're negotiating purchase agreements or investment agreements, disclosure schedules, employment or consulting agreements, governance documents, and any lender consents.
This is also where details matter. Definitions, caps, baskets, indemnities, escrow terms, earn-out language, what triggers what, and who controls decisions post-transaction. Founders should have strong legal counsel here, and the banker helps keep business points aligned with what was negotiated earlier.
And then, finally, close. Funds move. Ownership changes or capital is injected. The press release may happen, or it may be quiet. But the real outcome is, your company is now in a new chapter with new incentives, new expectations, and a new scoreboard.
Let's land this with a practical takeaway. If you're considering raising growth capital or exploring a partial or full exit, don't start by emailing investors. Start by asking, are we discoverable, defensible, and diligence ready?
And if you're working with an investment banking advisor, the best relationship is collaborative. You bring the operational truth. They bring the process discipline, market reach, and negotiation experience. Together, you turn a messy goal, we want capital, into a professional transaction.
Next time, we can go deeper on deal structures, minority growth equity versus majority recap versus full sale, and how each one changes control, risk, and upside.
And we can also talk about timelines, because the number one planning mistake is assuming this takes weeks. A good process can be efficient, but it's still a process. If you plan it right, you're not just raising capital, you're protecting the value you've built.